I want to bring in Jeremy Siegel, the professor of finance at the Wharton School at the University of Pennsylvania, also author of Stocks for the Long Run, who has said over and over again on this program, Professor, that we will see Dow 20,000 by the end of this year. So does that depend on a perfect earnings score by tech, Professor?
Well, certainly anything that's selling for a high price earnings ratio, 25, 30 or higher, you need to be perfection to keep your stock going. But I don't think we need perfection for the market to continue to go. We're selling around 18 times earnings.
Okay.
And don't forget, the first quarter has been terrible in terms of GDP. We're going to get GDP about 1%. So 18 times the first quarter earnings combined with extremely low interest rates, which are not going to rise that much this year. We don't need perfection for that, I think, to get to Dow 20,000 by the end of the year. But we do need some things to happen. And that is for economic growth to improve, for the dollar not to continue to soar in the markets. We're looking for stability in the oil price, and a rise in productivity.
Okay, but so Jeremy, here's someone who might be on the other side of this, who is getting a little bit worried. Doesn't say we need perfection, but we need at least earnings growth. Okay, so David Einhorn at Greenlight sent this letter out to his investors, and he says he's worried about how first quarter earnings have shaped up so far. We were supposed to be up about 5%. He says it looks like we might be actually down by that much. And he says in his letter, he says, quote, "This level of earnings degradation poses a risk to a market trading at a premium multiple of earnings assisted by record high margins." What about that level of fear?
Well, okay, first of all, a lot of the earnings, two things. The earnings shortfall by the rising dollar. 46% of the sales of the S&P 500 are sales outside the United States. We've had a 20% increase in the price of the dollar over the last 6 months.
Right.
That is huge headwinds that are coming, that are already coming. And by the way, we'll probably still feel a little bit of that even in the second quarter. Secondly, as I mentioned, 1% GDP growth with likely negative productivity growth. That's not typical of the economy. That's also putting pressure on those earnings. And don't forget, the oil price collapse has devastated the earnings of the multinational oil companies. So these are what I call one-off events. I'm actually pleased how earnings have come in this first quarter. I think we've got about an 80% beat rate on this first quarter earnings, given these headwinds. So I don't think that means that the next 3 quarters are going to continue to have those headwinds strike our earnings.
Okay, so it's an asterisk for you then, Jeremy.
It's an asterisk for me, exactly, and that's why I said, I mean, I can stand another 5% rise in the dollar. You know, that's about it. If it continues to soar, I mean, the Fed will have to give some sort of communication. Listen, guys, we're not going to be as aggressive as you think, because the rest of the world says we're the only, central bank around that is even thinking of raising interest rates right now, and all the money is flowing into our bonds and our capital, and that is really very, very difficult for our firms that are so internationally oriented.
If I read between the lines of what you've been saying, Professor, these last few minutes, is it sounds like, because we had Bill Dudley here at our Bloomberg headquarters yesterday. He expresses confidence that the economy is going to improve. He said, look, he's kind of like with you. Okay, first quarter, kind of hard, but it's going to get better the rest of the year. But it sounds like you're saying to me that we may not even get an interest rate rise this year?
I think the probability is yes. The market is putting a little over 50-50 on September. And listen, Fed funds at 25 to 50 basis points, which is a one-and-done situation, is not going to scare me, and I don't think it's going to scare investors. That long-term interest rate is far more important for investors than the short-term interest rate, and it really looks like that 10-year bond is going to be around 2%, likely this year and maybe well into next year. That's not scary for investors.